All right, what's up, everyone? We are gonna do a video on the database. So I was just kind of thinking what would be a video that would hopefully add some value, and here we go. This is basically where all of my effort and energy goes into on a daily basis. This is a Excel workbook that has, I don't even know these days, almost 1100 sheets. So yeah, there we go. 1085 different tabs that are going, and each one is for a different company. So you can see that it's all sorted by quality, basically. So there's 17 factors that are qualitative. We can go through each one of these. So the first one is that if the company is a founder-led company, or there's at least a 5% owner, just trying to look for some skin in the game. And you can see each company. So Axon, Rick Smith, NVIDIA, Jensen Huang. You could go down the list. Marcos Galperin, David Velez, Luis Van On. You can kind of go through each company and check them off. And it's just a simple binary yes, no for each of these questions. There's not a weighted scale. I've played with different things, but I think it gets to be too complex. And so this has worked so far. And then the second question is leader in space. So this is typically market share leadership, and it kind of just shows that the company has a brand, or it's top of mind, which leads them to get employees much easier, lower cost of capital. And so this is pretty much just talking about market share leadership. Notice that new is not the market share leader, it's about third. And then you can go off different metrics. Like, the thing is that this isn't all hard and fast, this is qualitative, so there's some gray areas for sure. Like, you could look at ServiceNow or something like that and say, oh, well, it's not the market share leader in software, but you could definitely say it's the market share leader in IT, which it really is. And then you could kind of go down the list. Like, Procore is, the big competitors, Autodesk's offering, and they don't um, probably does have market share leadership there. Meli wouldn't have leadership in general e-commerce, but in Brazil it does. So it, once again, there's kind of a gray area. Palantir is a really tough one, actually. Um, and we're just talking about the ones at the top of the list, but we could keep going down. But Palantir is a tough one in government software, like cloud-based stuff. You could make an argument it's the leader. So once again, qualitative, not necessarily hard and fast rules. But as we go down the list, before getting into the rest of them, they're all sorted. So right here, you can see Axon has a score of a 2. So out of all of the factors, they only have 2 marks that go against them. That means that it's the highest qualitative score in the whole database. So out of all of the factors, only 2 are negative. And then you can see if we go all the way down to the bottom, Wish, which is now Context Logic and has a different ticker because it's basically bankrupt, has the worst score. So it's just a simple positive and negative, pros and cons list, basically. And if you just do that over enough companies, you can kind of get a sense of whether something is high or low quality. Okay, so founder-led, market share leadership. Third one is, does it have a 10x runway? So is the market size, do you think that revenue can grow 10x from here? So this is yet again another tough one, because something like Microsoft or Amazon, if they're at 600 billion in sales, do you think Amazon can really hit 6 trillion in sales? It's a, or Nvidia, do you think they could hit 1 trillion in sales? I mean, it is very hard, but I think the most valuable thing here is to look if there's optionality within the business. So Amazon's retail TAM is probably 5 trillion. And then they're in cloud computing. So if you just took the retail TAM and cloud computing, it is theoretically possible, not likely, but the question here is getting towards theoretically possible for it to grow 10x. If there's just no way, the market, they've taken up 50% of the market and the market's not growing, this would just be a simple no. Like Duolingo, I have as a no here because there's been 500 million people that have downloaded the app. And if you look through all the churn metrics, it's just hard to believe that like most of the population would have downloaded the app at some point. Looking at 10x from that, and then there's churn statistics. But if you look at just simple revenue, there's definitely an argument to be made that it could hit 6 billion maybe. So it's one that you notice that I have bolded, which means that I'm a little bit less certain about that for the future. So my mind could change on this. If you look at some other ones, PME Pro Medicus is an Australian software company that I just have a hard time seeing that market cap increase just because the stock is so expensive. So that's, once again, not clear cut, but I just don't see there's any way of this stock being a 10 bagger. I think the revenue could probably increase. So it's either revenue or market cap, but typically, for the most part, it's revenue as this question. Moving on to diversification. So this is specifically talking about customer diversification, but it can also apply to supplier diversification. Something like Palantir, the government makes up most of the revenue. And if you really wanted to get technical, you could search through and find all the different departments. Like the Army would be different than the Navy, and you could maybe not lump those all together. So if you really broke them out, then you could maybe give Palantir a yes on this. But once again, the whole point of this is trying to think through all of the concepts. It's not necessarily to get the perfect answer. I mean, obviously, you're trying to get the most correct answer you can, but really you're just trying to think through the different aspects of the business. And I think that these factors, if you really thought through each one of them, you would have a very good sense of where the weak spots are, where the strengths are of the business. I gave a bolded yes for Meta because Temu was, I think, like 9% of revenue, so it was getting closer. Now it's come back down, so you could probably take this off. But you can also think of Meta's reliance on Apple as sort of a diversification or lack of diversification. So it's important to really think through the whole ecosystem of the business. What's another good example here? So Kinsale, if you look through all of the annual stuff, you'll find that some of its brokers make up 17% of revenue. So if it makes up more than 15%, then I give it a no, and it's kind of a hard cutoff. You could look at NVIDIA as the hyperscalers. So if you break out all of Microsoft and Amazon, you actually find that there's less diversification than one might think. And then there's also China risk. So when I found out China was 25%, and then there was the whole curbing with the restrictions, then there was a pretty easy no for this question. And then here we actually get into the next 4 questions are actually entirely quantitative. So it's kind of a mix of qualitative and quantitative here. And so this is if the last quarter revenue growth was over 30%. This is if the next, if you project 4 quarters in advance, is it very likely for revenue to grow 20%? So you can click into any of these and you can sort of see the guidance. So we'll click into Axon. Here's all the numbers. You can see that the last quarter was 34%, and we note that here. And then if you estimate forward 4 quarters, it's likely to be 24%, or the guide we have for the year is 29%, which I have right here. So if we go back to the watch list, you can see that of course, Axon with 34% last quarter, and then 29% is green right here. And then for free cash flow positive and EBIT, these are free cash flow would not take out stock-based comp. We include that in another factor, but this is trailing 12 months. So if a company has 1 quarter of GAAP profitability on an EBIT basis, they still have to get 4 quarters. So it's a higher bar. So something like Samsara, free cash flow positive on the last 4 quarters, 47 million. And then on GAAP basis, it's still very negative. So it would be a no on this question. And this is trailing 12 months, not just the last quarter. So the revenue is 30% for the last quarter, but then profitability is a higher bar to reach. Okay, moving on to pricing power. So this is pretty straightforward. Can the company increase prices? And this is honestly a pretty hard question to answer in some cases because like something like Mercado Libre, if all of a sudden they just increase their prices, they have competition from Temu and Shopee. When would people start migrating other platforms? I think you can make the argument that because they're investing so much in logistics, that the free shipping and the convenience could actually give them some pricing power. So that's why I've bolded it as well. And you see that actually I've answered it separately for Amazon because I do believe they have such a big moat in logistics and you can get 1 day shipping on so many things that there actually is pricing power that I don't even check Walmart.com or something like that. Not to pick out Walmart unnecessarily, but it's just Amazon has such a strong moat in logistics and Melly is getting there. And so I haven't quite given it a yes. I mean, if I gave Melly a yes, it would be one of the highest scores qualitatively. It would jump up right behind Axon. And so I'm always looking in context of all the factors, like this pricing power might not be a yes, but if it was, it would actually shoot up. And so that gives me more confidence in Melly. Something like Duolingo, if they increased the subscription price 20% overnight, I think a lot of people would actually churn. And so it's really important to think of all the factors here. Something like CrowdStrike, there's such this. I think they actually do have some pricing power, and they've shown that against SentinelOne. Tesla is a really tricky one. I think I'm quite biased on the company, but they have clearly been decreasing prices, and that is to stoke demand, especially across a higher interest rate environment. But they do have premium quality cars, so you've seen them oscillate the price a ton. They brought it up and brought it down, and so I do think they actually have pricing power, especially because they have done such a good job of manufacturing and bringing costs down. So I do think that they have a really good value for the cars. So you could disagree with me on that one, and it's still bolded once again. So I bold all the things that I'm a little bit unsure of. And so once again, it's really just trying to think about all of these dynamics and how they work together. And then the hard to replicate. So this is sort of like a classic moat question. And then the next one is the moat growing. These are kind of two components of the moat. And I think it's important to get a few of these factors in, like pricing power would, you could argue that it would constitute some of the moat discussion. It could be definitely valid. If you have absolutely no moat, then you probably don't have any pricing power. So these are kind of the 3 moat questions that are really important to look at. And hard to replicate is probably pretty straightforward. Is the business hard to replicate? And if you gave a competitor $1 billion, would they be able to build something that's somewhat similar? And so a lot of software companies probably deserve a no on this question, because the barriers to entry are fairly low. Like Datadog, there's tons of competitors out there. CrowdStrike, SentinelOne is definitely different. You could probably give this one a yes, and once again, it's bolded because it would be pretty hard to replicate the data advantage that they have. Something like Appfolio, there's Yardi, there's a bunch of RealPage, there's lots of different competitors, and so I think it's fair to give that a no. And then, is the business more relevant? So it's pretty hard to score a no on this. You see that there's many, many yeses in here. The first one is Workday. That's sort of arbitrary, but it's just, do I feel like the moat is getting stronger or weaker? And in Workday's case, I feel like there's a lot of competitors. It's not necessarily as innovative as it once was, but you could definitely disagree with that. Adobe, I had it as a no, but I've switched it to a yes because I feel like they've really shipped a lot of AI products. So you see that this is probably one of the lower bars here because, especially towards the top of these companies, if you're not like, since the fact that they're growing, it's pretty hard to score a no on this. I did actually give Bill.com a no here because I just feel like Ramp and a lot of these different competitors are much stronger, and so they're becoming actually less relevant in the marketplace. Once again, you could definitely disagree. Something like Alibaba, I gave a no because Pinduoduo and JD are just really strong competitors. I don't feel like Alibaba is actually getting more relevant. And then this is one of my favorite questions. Does it have any real competition? So every company out there has some sort of competition, right? TSM has, this is Taiwan Semi, they have Intel and Samsung, but do they have any real competition? And I think that it's very subjective, but something like Nvidia that has 90% market share in AI chips, sure, AMD is a competitor, but not a real competitor. It's basically, here is the market share so wide that it's as if they don't have any competition. Something like Axon, sure, they have some competition, Motorola, but I wouldn't consider it real competition. Amazon, sure, maybe you could say Shopify is competition, but not real competition in its actual retailing business. Tesla, once very biased, but I don't think they have any real competition in self-driving. I think they have such data advantage that it's actually very difficult for the company to for competitors to catch up there. And then this is another quantitative metric. Is there just net cash on the balance sheet? I don't want a company that has a lot of debt, so that's pretty straightforward. And sometimes if it's really close, like this Australian company has a tiny bit of debt, so I'll give it a bold right there. And then this company, this question is, it's kind of a mixture of three different questions. So one, am I excited to own it? Two, is it a win-win-win for employees, customers, suppliers? And then EU is it easily understandable? So if I don't understand the business, it's a quick no right there. If I'm not excited about the business, it's a quick no. And something like TSM, it's the only reason I give it a no is because there's a huge China risk, if they were to invade Taiwan. So that's not easily understandable. It's very, very hard to understand that. So I gave it a no and bolded it. Some other no's here. This is a company based out of Hong Kong, so kind of a similar reason. So pretty much any Chinese company, I'll give a no there because I feel like it's not easily understandable. And what else would be a no? So this is a online gambling company, and I gave it a no just because I'm not super excited to own that. So something like that. Kaspi is a company from Kazakhstan. Once again, sort of the geography risk. I don't easily understand it, so I can give it a no. And then, even as we go down to look at some more familiar companies, let's see here. So something like Alarum, I've bolded. Originally, I wasn't super excited about it because there's some gray area with the ethics of data scraping, but as I've understood really what they're trying to do, I've changed my mind on that. And so this is what's great about the system is you can change your mind based on the scores. So if the facts change, then your mind has to change because you have a new score. So all of a sudden, if revenue dipped below 30%, it would completely change my score, and then the company would get bumped way down in the scoring system. And so you can have, you can be really excited about something, but if the score changes, you have to change your mind. And so it's really just a simple, elegant way to change your mind when the facts do change. And so moving on, we're almost done. Is goodwill less than 5% of the market cap? So if you can see here, or of enterprise value. This is a company in Sweden called Intellego. It has $8 million of goodwill, which is basically means they've done some acquisitions and they had to attribute the excess purchase price to goodwill because they couldn't make the argument to the auditors that the price was justified based on hard assets. So it's sort of or intellectual property. It's sort of like excess. How much did you can sort of think of it as how much did they overpay for an acquisition? And so this is really gets at capital allocation. I don't want a company that's doing a ton of big acquisitions and then has a bunch of goodwill on the balance sheet because that shows that they're probably overpaying for larger acquisitions. And so most of these companies, like Procore, has done a lot of tuck-in acquisitions, and so goodwill makes up just over the 5% threshold. But I've given that I probably bolded that because it's right on the edge. So what's an example of a company that's done some big acquisitions here? So yeah, Salesforce, they've done some huge acquisitions, Slack, Tableau, MuleSoft, you can kind of go back through. And so goodwill actually makes up 22% of their enterprise value. So it would get a no on this question. So Salesforce has done an amazing job on their acquisitions, but it's just a personal preference that I don't like companies that do large acquisitions because it probably means that they've run out of organic opportunities. Not always the case. And so once again, you have to take a lot of this with a grain of salt. You're just trying to, like, what's important to understand here is that these are my personal preferences. These aren't necessarily set in stone or that everyone should have these. You can create your own scoring system with things that are really important to you. But I found that this really works for me. And since we've instituted this process over the past year and a half, the results have been very satisfactory. So I'm really excited with the trajectory of things. And this is essentially what I use to pick the stocks for Investing City and the fund. And it's just getting more and more rigorous as we sort of refine the system. And so that's goodwill. And then moving on to recurring revenue as more than 50% of the overall business. So if it's a simple ratable software business that is 100% SaaS, then that would be an obvious yes for this question. And then where things get a little trickier, like Axon, I think their software business is like 40% or something, so it's almost at the 50% threshold. Bolded because so many of the purchases I make on Amazon are recurring, stuff like dish soap or little dishwasher pods. But you could definitely make the case that it's not recurring because, if we went into a huge recession, people would probably start using Amazon a little bit less. But because it has such strong convenience and value proposition, maybe you couldn't. So it's really just trying to think through all these factors. Procore is actually a usage-based model. So I bolded it. I probably bolded Snowflake down there. The usage-based models are sort of recurring, sort of not. Something like Shopify actually gave a no because the software is less than 50% of the business. Actually, more of the business is payments. And so gave a no there. What else? Yeah, obviously Coinbase would not have recurring revenue at all. And this is a bit higher because, like, in the system right now than I would have thought because, revenue is going crazy because the price of Bitcoin and all that. And so it's probably a little bit artificially high on the qualitative score right here. Something like the Trade Desk not quite recurring. They make a take rate off of the gross ad sales through its platform. Apple, not recurring. iPhone still makes up a good chunk of this. Looking for smaller companies. So this is actually not part of the system. I don't include it in the final score, but I think it's fun to look at the enterprise value and see if it's under 10 billion. And I just find that smaller market caps, especially if it's a quality company, tend to give you a longer runway. But these days, that's completely changed. I mean, Nvidia, Microsoft, Amazon, Meta, Google, these are all over $1 trillion, and 3 of those are over 3 trillion. So the numbers are just getting bigger and bigger these days. It's pretty crazy. But I like just looking for smaller companies if possible. And then last two factors, um, this one is the product mission critical, or this is a or. Notice that there's a slash here, versus the excited question. It's an and sign. So this is, I have to be excited about it, win-win, and easily understandable to get a yes here. And then this is an or question. So is it either mission critical, or is there a huge consumer surplus? So something like Costco, it wouldn't necessarily be mission critical. I mean, some people would definitely argue that, but you can get your groceries other places. But there's such a huge consumer surplus that it's an easy yes on this question for me. Kava, I definitely think that you could give this a no, but it's so tasty that I gave it a yes. That's really subjective, but I personally, it's one of my favorite fast food restaurants, definitely more than Chipotle. It's definitely not mission critical, but I do think that there's actually consumer surplus, even though they have significant pricing power. Here I gave Tesla, it's not mission critical to buy a car, and consumer surplus is really high. But I thought that if you give Tesla yes on pricing power, then you'd have to give this a no, or vice versa. I don't think you can get both pricing power and consumer surplus for Tesla specifically. So it's probably more accurate that I give this a yes and then pricing power a no. But I've just been going back and forth and thinking through all these dynamics. Duolingo would say it's not mission critical. There is consumer surplus, definitely, if you're a free user. Um, so yeah, I would say that you could definitely make the argument that this could be a yes. Um, However, with hard to replicate, yeah, it's just thinking through all these dynamics can be really tricky. And sometimes it's like, maybe that is a yes, maybe that's a no. But once again, the point is to really just think through everything. So I would say that Duolingo is certainly not mission critical. And then consumer surplus, this is specifically talking about the core of the business, which is the subscriptions. And so since churn is so high, you could definitely make the argument that there's not a gigantic consumer surplus. Obviously, with the free users, that's amazing consumer surplus. That means that the consumer is getting a lot more value than they're paying. And if it's free, it's pretty hard to do better than that. But this is talking about specifically the paid plans, and I decided to give it a no there. And then last one is revenue accelerating, or is it growing more than 20% quarter over quarter? This is just seeing if revenue is accelerating. Pretty straightforward. NVIDIA, once again, this is probably the most qualitative of the quantitative factors. So somebody could say it's accelerating, somebody could say it's decelerating. So you can see that NVIDIA is clearly accelerating year over year, like 262% versus 13% last year. But if you look on a quarter over quarter basis, slight decel, and you went from 88 to 34 to 22 to 18, and then your guide is 8. So it's hard for me to say that it's actually accelerating from here, especially if you look at the gross dollar ads. I don't actually have it right here. But if you're looking at the gross dollar ads, they're slowing down a little bit. And so I was also extra harsh on NVIDIA because it's doing so well. I think it's important to really, stay diligent. And this is, I've talked about it in my quarterly letters of the fund. This is clearly the biggest mistake since the start of the fund, because NVIDIA was, top three in terms of the qualitative system, but I just didn't put it in the portfolio because I thought the market cap would never reach 3 trillion. I was just way too conservative on my estimates, but 100 billion in 2026 EBIT can certainly warrant $3 trillion valuation. I just did not think that they would grow quite that fast. It's truly amazing. And so I gave it a no, but it's bolded. You could convince me otherwise, but I feel pretty confident in that. And then Appfolio, it's clearly accelerating because they increased prices on their payments side of the business. So it might be like a one-time boost and might slow down from here. So that's why I bolded it. So it's really, you got to know every company and think through each of them, add them to the system. And I've really just talked about, the top 20 or so because it's convenient right here. And there's lots of colors, lots of different things, but I believe this is just if EV to sales is over 15. It's red because higher is worse, all things considered. And then green is low. So that's the qualitative system, and that gets you this nice, neat number, which everything is ranked by. And so that's the qualitative score right here. And then the quantitative score, which is a whole separate video that I could go through. We're already at 30 minutes. This is quite long. But this is another mixture of factors. It's basically forward growth, and then free cash flow margins averaged with stock-based comp. Just make sure that stock-based comp gets in there. And then 2 times the valuation. So you can see these are the factors right here. You have valuation. If you look, it's just a simple 5 years earnings model, and I get a expected CAGR, and then the guide, and then free cash flow blend, which is a mixture of free cash flow and stock-based comp. If you put all this together, and I've given some weights based on the importance of each metric, you get a quantitative score. And then once again, it's color coded. Over 80 is yellow. If you're under 80, it's red. Over 100 is green. So you can actually see some companies that are green, like Alarum, and some other smaller companies. Celsius with its pullback is almost green, but it has a lower quantitative score, so you have to trade off with all the factors. So Celsius might be an instructive one to look at. It's clearly decelerating, mission critical. Some people would say that caffeine is, but consumer surplus, you can get a can at Costco for, if you buy a big pack, you can probably get it for a little bit over $1. It's pretty good consumer surplus compared to competitors, and especially compared to coffee. So it's a kind of an iffy one. It's also iffy that I'm super excited about it because it's an energy drink, just not personally that excited. So I feel like Celsius is pretty generous to give this a 5. If it was a clear 5 and 100%, it would probably deserve a place in the portfolio. But this, how I'm just thinking through all the factors. Like Alarum, start off as a smaller position because it's really fast growing, but the qualitative score is not, super top tier. But mind you, this is still in the top 40 of 1,100 companies. And so it's still top 5%. And just as a personal rule that I found, I never invest in anything on this score that is more than a 5. I've just found that if you stay in the top 5%, you generally are picking much better stocks. But notice that right here at 6, this is not Chipotle, this is a Canadian company, Computer Modeling Group. So at 172, so basically 6 and lower is like the top 20-ish%, the top 17%, and then it's kind of like the 80-20 rule. It's kind of funny how it just happens to be that right here. The top 20% of the companies will probably provide 80% of the returns. And so there's some really good companies in here. It's just that I want to invest in, you sort of have to give a minimum quality score, and then you can look at all the valuation. Like these are very high quality companies. TJ Maxx, Wingstop, FICO, Cintas. These are incredibly high quality companies. TransDigm. It's just the valuation is really high. So if you look at the valuation here, there's really not that much upside in my opinion, and so that's why they rank very low on the quantitative score. And so you're really just trying to look for the highest qualitative and quantitative scores, and that's what creates the portfolio. And that doesn't tell you exactly how to size everything. I have a different strategy for that, specifically in the fund, but it definitely gets you most of the way there. So these are really good companies. I mean, this top 100, most of these companies are really excellent. It's just that the valuation might be a little bit high, and stuff like that. So something like Elf, uh, pretty high up, but I think the valuation is high. Um, Transmedics still trucking along. That's pretty good. I mean, it used to be well over 100% until, but the stock has like quadrupled off of the lows, and so I've just held because I'm not really eager to get out of that. So it's a bit fluid. It's not like hard and fast rules, but this is all of the information that I'm gathering and distilling every single day to get into the portfolio. And so I know that um, it's a lot and a lot to kind of, it's probably like drinking from a fire hose, but this is a system, and this is the video I wanted to post out there today just to go through it much more in depth. And as Investing City members, you have access to this. And I just want to make sure that everybody knows that. And yeah, thanks for watching. If you watched through this whole thing, you are a legend. Well, have a great rest of your week, and let me know if you have any questions on this.